Maverick traders. Welcome out to your currency midweek for September 28th. Corey here with you. Plenty to talk about today as there's been a ton of volatility. Whenever there's massive amounts of volatility in any asset class, but currencies being one of them, like we've seen in the British pound and US dollar skyrocketing, etc., there's somebody blowing up somewhere. The question is who and where are they at, right? Because a lot of these models are based on the idea that you'll only have volatility similar to the past. And when some extremes happen, well, you get the turmoil that's the after effect, right? As people are liquidated and it further fuels and pushes that. So plenty to talk about today. Stocks, we've emphasized this point. Look, we're in a bear market. We've pretty much moved into a bear market, and even with some of the equity rallies and different things that have transpired, we try to emphasize this point that you have rallies within a bear market. The Fed has begun in earnest to shrink the balance sheet, quantitative tightening, and really they're left with no choice. And it's the right thing to do in essence, in that they do need to. I mean, look at how much they have to pay in debt. Right now, a 2-year bond is at 4%. So just think about that in terms of they now have to pay. Now, we had rates at zero for a long time, right? And it made sense to just print more money and print more money in their minds. But it's kind of idiotic because, of course, rates will, go up at some point in the future, especially when you try to stop. And so they just got addicted and they just kept printing and printing and printing as if they had total control over interest rates. And they don't. They can't control the market. And once they stop buying, rates skyrocketed. And now, if you just think about having trillions of dollars of debt and then how expensive it is, and that's for a 2-year bond. Imagine the government having to pay 4 and 5 and 6 and 7% and so forth on all of those trillions of dollars of debt. Guess what the debt repayments end up costing? Well, more than all of their spending for healthcare and more of all the government spending for discretionary items and so on. That debt expense, the interest expense alone, becomes gigantic. So it's a big issue to have this much debt, and it's part of what's fueling inflation. I mean, this should have been basics. When you go through a basic economics class, I mean, if you're going to print money, if you're going to send out checks, if you're going to do bond buying programs, what's the concern? Well, the concerns are inflation. The concerns are how much interest you have to pay on all that debt. And if you keep acquiring and accruing more and more of it, I mean, it's sort of mind boggling that they seem surprised that all of this is transpiring. So a bit of an issue, right? And you're seeing, frankly, markets breaking down because they don't have any control. Because where the Fed used to be a huge buyer in bonds and some of these other things, they're not there anymore. And so everything in the markets is supply and demand, right? Well, they were the huge buyer, driving bonds higher and higher and higher. You remove them and everybody else goes, well, I don't want to buy this junk. And so there's more supply and away we go until they kind of, decide to step back in. But even then, it's just temporary. They've really worked themselves into a mess. I said this last week, and I've said it for many years. In a world where there is no Federal Reserve, does the market perform better? Do markets act more normalized? Do bubbles and bursting of bubbles and all these things have such lasting impact? And it's not to say that everything would be perfect, but I truly wonder if they don't create more problems than they've ever solved. US dollar remains in breakout mode. As we surge, we said, look, it's going to be hard for risk assets, but this is what happens in bear markets. Look at any bear market. If you go through the last few recessions, 2020, when the markets cascaded lower, what was going higher? US dollars. 2008 in the credit crisis, as the markets collapsed, what was going higher? US dollars. It is a safe haven in times of risk and times of uncertainty. Now, the big news. So in England, I mean, obviously, with what's been transpiring there, I talked about when volatility goes way outside of statistical norms, something breaks and somebody is getting blown up somewhere. So the Bank of England is rolling out a new quantitative easing program. They're going to start buying 65 billion pounds worth of UK bonds. What they're trying to do is stem the row. They're basically trying to say, okay, there's not enough buyers, we'll step in and be one, right? So they're buyers for all of these sellers. And what does that do? Well, of course, the British pound has been collapsing to the downside versus the US dollar. We're not too far off parity. Think about where the pound started this year at like 133. It took $1.33 US to get 1 pound. I think it's 108 right now, right? Right around there. Think about where the euro started. Think about where it's at right now, where it takes like 97 cents US to get 1 euro. There's a rout happening in these markets, and their response is the same response that they've always had. They basically say, well, everything's broken. We have to step in there and be a buyer. And so you're seeing that happen in the UK, where they say these things are getting blown up, and what they see, guarantee it, what they see is contagion risk. What they're doing is not something they want to do, but they feel like they have to do. Now, it will be debated whether that's smart or not, but they feel like the choice is out of their hands. I guarantee they are having emergency meetings, and whenever central banks are having emergency meetings, crazy stuff is happening. And so this is not something that they had planned for. This is not something that they thought, this would be a good idea and this will be great. And, we do this in a calm and normal market. Heck no, this is out of basically kind of panic. They're responding to the markets breaking and the risks, and then there's contagion risk. And I'm not saying it's 2008, global financial crisis, but in international markets, it's much closer to that than it is here in the US. The US dollar skyrocketing doesn't have as much of an impact on us as oddly as it does everywhere else. So many things are priced in US dollars, commodities around the world, so many things, so much debt is priced in US dollars and so on. So we sort of don't notice in our day-to-day life if the US dollar is strong or weak. Maybe if we take a little trip, right now would be a good time to take a trip overseas because you'd get a lot of euros for your dollars or a lot of pounds for your dollars or whatever. But you really don't notice. It's creating other problems, right? And you're seeing that. I mean, the British pound has been collapsing, kind of crashing of late. And so there's other things happening there, and their bond market's collapsing. So they feel like they have to step in and stabilize. And it's a really weird world we live in because you have some still kind of easing and some tightening, and so there's this bifurcated market where you just have to tread carefully. I'm not saying you can't trade it. I'm not saying there's not opportunity, because there's always opportunity in this, but just be careful because yeah, you can have massive moves for you. You can also have massive moves against you on one announcement here or there. So certainly trade with some caution here in the near term. Volatility has really expanded worldwide. Core durable goods less than expected. Durable goods orders less than expected. Pending home sales worse than expected. The only thing that bounced back was consumer confidence. And what is consumer confidence tied to? This is a theory that I've had recently, and that number would suggest I'm exactly right. Consumer confidence hit 50-year lows recently, in the months past. And I said at the time, I believe that it's directly linked to gas prices. For one reason or another, in the US and probably around the world, people love to complain about gas. And if that goes up, the consumer feels terrible. If they see that they used to pay, $80 to fill up, now it takes 110, they're just going to feel terrible about that. So why did consumer confidence bounce back when we've got all these issues and inflation running wild and markets collapse? Because they just frankly care most about oil, about what they're paying at the gas pump. And that has been going down of late. And so you're seeing these consumer confidence numbers bounce back. I really believe that that is, that might be consumer confidence slash how are gas prices doing. If gas prices skyrocket, you'll see those consumer confidence numbers start to tank once again. So let's look at weekly performance. As you look at the markets, pretty flat here in the US so far. Obviously, that's not been the case for the past couple of weeks. If you look at the chart, I think we're down about 12 to 15%. I don't remember the exact number, might be around 13% in the last 2 weeks. That's a huge move. I mean, 13% of the total market value wiped out in 2 weeks. So this week, a little bit of a pause. Now, I've had a pretty bearish tone and concern tone. It might surprise you. I actually think the market's going to bounce here. I think we'll look at the S&P chart, but I think we're going to have a pretty decent rally. I'm not sure it'll last. I think it'll be kind of an inverse cup and handle, but I expect some bounce. Gold and oil and crypto bouncing a bit this week. So there's actually, after what has been a hellacious couple of weeks, there is a little bit of a bounce back. Let's take a closer look at that S&P chart. So here is your inverse cup, right? And so you're probably going to bounce from this low. That's what I suspect. And 30% of the size of the cup is about how far you'll bounce, and that's up to about 38.50. So that's kind of where the handle will probably fail and phase out. And then I would anticipate another pushback to the lows and probably beyond the lows. I suspect, I think it's going to be a rough time overall going into next year. We're kind of in or going into a recession, whatever you want to call it. This is just not an environment where you want to be loading up and taking a lot of risk in the short term. I think you can play it for a bounce, and it's a decent sized bounce. That's a good sized rally. But oddly enough, if you look at this decline, this rally here would just bring us into like the Fibonacci zone, the bearish retracement. You take this huge drop, you bounce nicely, but then you're just going to drop back down again, would be my expectation for the S&P. So I don't think we're out of the woods by any means, but I do expect a rally. So far this week, Kiwi, this has kind of become a recurring theme, it seems, where US dollar and Swiss franc continue to be strong, Kiwi continues to be weak. As we look at crypto, that's about as quiet as you can get in the crypto market. So Bitcoin bouncing back slightly, but as you look at the charts, it'll almost look just kind of flat. And I don't know that there's a great environment there. As we look at some of these other markets, look, we're in a full-fledged bear market, but really in the short term, I'm a little more in the green. I think that, people are panicky. I get it. That sets up for a relief bounce. So I'd be more in this category for the next week or so on equities. Do I expect it to last? No, not at all. But I think we're going to get a bounce here in the short term. Let's look at a few other charts. If we look at international markets, they already broke down, and this speaks to the weakness fueled by the US dollar. Should we bounce in European equities? Yes. You'll probably come squish into that old support that's now a new resistance and then kind of fail there. Again, similar to the S&P, you're going to get a bounce, but it's going to likely fade off and continue in that downward trajectory. Crypto, I don't know that there's anything you can do with this really. If you have a trade, if you want to trade it, I think you have to continue to kind of focus on the downside more than the upside, given the charts. But it's just a choppy market right now. It's kind of a quiet market for how crypto normally trades. So you just kind of look at this and it's just bouncing around. I mean, it's just choppy, and I can't really make heads or tails of where that next little move is going to be. So I've got no real interest in crypto right here in the short term. For the rest of the week, let's take a look at what's on tap. So today you got some GDP out of Canada. Okay, little worse than expected. Was expected to be slightly positive, ended up slightly negative. You got, pardon me, that's coming out tomorrow. Pardon me. That was last one. This is the projection. Sorry, I was looking too low. Pending home sales, we already talked about. That was worse than expected. And then you've got GDP coming out in the US as well. Both of those expected to be in negative territory. So Canada expected to be minus 0.1. Here in the US expected to be minus 0.6. You know, being down 0.5% in gross domestic product, not good, right? Not what we're looking for. CPI numbers and core PCE, which is kind of an inflation gauge here in the US, at positive 0.5 expectation. It would really be good for the markets if they started to see some inflation numbers work in reverse. What the market needs is some indication that inflation is backing up. The worst case scenario for the markets, I mean, what if you had an economy that's breaking down, the Fed trying to fix it by tightening and raising rates and so on, and inflation staying up here? I mean, that's a possibility. You could have a stagnant, even a recession, and inflation staying up there, and that, I mean, that's a cocktail that gets messy. So the good news is we've already seen some inflation numbers coming down. I mean, just look across the board at commodity prices, lumber, and all these things that are down, 60% and so forth. So we're certainly seeing a lot of that come out. You're seeing oil that's been hit recently. I mean, a lot of these things are deflating, no question. We haven't seen, rents are a big part of it. Rents are a little bit more sticky. It's not like people just start dropping rents immediately because an inflation number here or there. It takes a little time, and there's a little bit of a lag effect there. So there's some parts of inflation that are probably going to stay sticky and higher. And so that's why you're not going to just get back to 2% immediately. It's going to be a little bit of a time before we can kind of fully get there. So let's take a look at a few charts. I wanted to come in and just look at some of these moves in the British pound. I mean, it's pretty astounding. This is the euro against the pound, and you can see, I mean, even though the euro hasn't been a great currency, you can see that acceleration. This is a daily chart, and especially towards the end of last week when things just went bonkers. Did the market catch wind of the fact that basically, these emergency announcements that the Bank of England was going to step in and start to devalue their currency through essentially money printing, quantitative easing programs? Seems to have been kind of priced in ahead of time, right? But look at the pound versus the US dollar as an example. Just go back a couple of months and we were trading at 130. It took $1.30 US to get 1 British pound. Now it takes $1.08. Just a few months later. That type of volatility is not the norm, right? When we think about volatility, if you were to price it out, what's a 1-year expected volatility range for pound USD? It probably would have been in the neighborhood of, I'm going to guess, maybe 12%. A lot of the slower currencies, US dollar versus the euro, would be even less than that. Maybe it prices in 9% total annualized volatility or something. If you look at some currency pairs that are heavily correlated, it might even be as low as 8% expected annualized volatility or what have you. But currencies are not supposed to move on percentage terms as wild as other things. They're not supposed to move against each other 40 and 50% a year. Stocks can easily do that. Stocks can easily have 40% annualized volatility. Well, currencies, not so much. Well, just since, I mean, if we just pick a point in time, just since here, in May to this downward decline, you're talking about, well, what is that? It's above 125, call it 126, down here to 108. I mean, just think about that volatility move from 126 to 108 is 0.18 divided by the 126. That right there is a 14% move just in a couple of months. That's a real change. You can also kind of convert that into thinking of, well, it's 14% less expensive to convert your US dollars into British pounds. It got 14% more expensive to go from pounds into USD. So, people traveling to the US from the UK got more expensive. If we go travel over to England, hey, we get more pounds for our US dollar. We can stretch that money a little bit further. So there's some other aspects to it. Same thing in Europe. Obviously, it only takes 97 cents US to get a euro now. So you can really stretch your dollars traveling internationally. I didn't time things too well, I guess, because I traveled to Europe in 2019 and my dollars didn't stretch that far, So crazy amounts of volatility. I think this is a case where if you were to just say news versus price action. The announcement that came out that the Bank of England is going to start to initiate that bond buying program, what is that for the pound? Well, that's bearish, right? So the news for the pound is bearish, yet the price action on the pound, look at it, it's bullish. Pound is actually bouncing back, isn't it? So it's one of those cases where it got priced in ahead of time. I don't know who knew what. I don't know, exactly the aspects to it, but you can kind of see that pound was selling off, selling off, selling off, selling off. At the end of last week is really where the market realized. The market as a whole realized that basically, bad, and frankly, you could argue it knew it ahead of time even before that, but it basically was pricing in something different. This is where, the panic set in. This is where people said, this is going to be really bad for the pound, and we accelerated. We went from 112. I mean, there's a 2-day volatility surge from 112.50. We hit as low the very next trading session at 103. I mean, put that into perspective. That's about a 10% drop in just, a 2-day period. I mean, that's crazy. That's crazy amounts of volatility right there, moving, 1,000 pips or what have you. So that's where things really went wild, right? I'm not super surprised that the market's bouncing back. I mean, there's probably this is really kind of a smart trade on this news. When the news came out and it was already panicked and in this exhaustion, I mean, what a perfect stage 4 exhaustion. Remember the 4 stages of a trend that we talk about? This is a concept that I kind of created and developed of thinking about how prices move, and I compare it to a marathon runner, right? Where stage 1 is a resting phase, and then stage 2, you start the race. When the gun goes off, there's like this big jolt of energy. That's a breakout, right? In this case, to the downside. Stage 3 is just grinding through the race. And then stage 4 is when you see that finish line and you make that final sprint. When you make that sprint and you just exhaust the last bits of energy that you have left in your body. You literally almost can't take another step. Your body, in many cases, people will collapse across the finish line. I mean, they literally used every ounce of energy that they have, right? And that's kind of what happened here. Is this has been ongoing for a long time, right? The race started back in the past. This looks more like a finishing touch, kind of that final exhaustion. Anyone that is willing to sell the pound sold the pound on this news, on this reaction, on this finishing touch. It's that exclamation point at the end of the sentence. And what happens most of the time at the stage 4 exhaustion low, what candle is most common? That one. Long lower shadow, hammer-like candle. When you get that long lower shadow, that kind of, for lack of a better term, they call it capitulation. It's just basically throwing in the towel. Just your hands go up in the air. Okay, too much pain, no moss, can't take it anymore. That's it, right? That's where the hammer comes in. And so realize last week we didn't have the announcement yet. Even today's reaction, kind of the same thing. We've already exhausted all sellers. The path of least resistance at this point is a bounce back. So kind of interesting how that trades at this point, bouncing on what theoretically should be really bad for it. Let's look at a couple of other aspects to this. So maybe we'll come in and look at some of our currency baskets. US dollar, I personally think, again, there's a lot of times a correlation between them. And I said that I thought the US dollar would kind of have an exhaustion move, but I was wrong, certainly about kind of where that might take place. I thought, we could have this around the Fed meeting, sometimes the day after. So I didn't expect it would happen on that Wednesday, but I said the day after, that Thursday, is where you might see it. You might see that kind of exhaustive phase. Well, Wednesday was crazy, right? And then you got Thursday and you advanced further. And then you got Friday, and that was kind of the finishing touch. And, today you can see how the US dollar is really coming off. It was a little, I was guessing at when it might occur, but I think it has occurred at this point. Few days later, but that's okay. I think we've seen kind of an exhaustion top. Now, exhaustions can really have one of two ways that they trade. What do you do when you become exhausted? Well, you rest. So this could kind of just move into a choppy sideways phase. In fact, that's not all that uncommon. In more extremes, you'll come off violently the other direction. So this could just start to really come off, or it could be choppy and then kind of start to come off. But either way, I think that in the short term, I don't want to be buying US dollars right here as it kind of created that capitulation, that exhaustion to the upside. I don't want to be shorting British pounds in the immediate levels. Let me preference that by saying that's not my focus over the next couple of weeks. Could I take a trade shorting the pound? Maybe. Maybe I see a setup on the hourly chart or something and I trade it for a few hours. It's possible, but I'm not, that wouldn't be my focus. I think US dollar has kind of created that exhaustion top, similar to the pound, but in reverse. You see the hot, long upper shadows. Those tend to be more at a peak, right? At a peak level when you've created a little exhaustion. And this one just looks different. It kind of looks like you put a big exclamation point at the end of this move, right? That's what you like to see. Let's look at a few of our other currencies. CAD, boy, I don't know what to make of this. We use the same portal, Rob and Ankit and I, for these classes, but if you look at the CAD, that to me is the price pattern. So, I don't know who was drawing the other lines or what they were looking at, but that to me is where we're at. We're in an ascending triangle. You could break up, you could break down. Either is possible. Odds suggest you'd be more likely to break up than down, right? That's the more likely outcome. I don't know if it's 7 out of 10 or something like that, but maybe 70% of the time you go with the trend. Maybe about 30% of the time you break the other direction. But I think at this point, we're kind of in a wait and see mode. Let's look at a couple others. Australian dollar, okay? Trending lower, but look at the long, long, long lower shadow. I mean, this one could be creating a little line there of prior lows and support. It's messy, it's choppy, it's kind of a descending triangle in essence, but I do give today's price action quite a bit of weight. I mean, things could have gotten really ugly and they reversed off of those lows. Let me skip to, that was the Aussie, let me skip to the Kiwi because it's similar. I also think the Kiwi, which by the way has been the worst currency, we talk about it, you keep shorting it. I cannot get behind that at this point. Today, to me, is an important day for the markets. Today, when you see a central bank make a major policy shift, it sends ripple effects through global financial markets, and it can have some lasting impact. That's what you're seeing in these price action reversals. This to me is the market, whether the market goes more easy, whether other central banks turn and say, we've got to do stuff, I don't know, but it's going to make people nervous. So if you're short the Kiwi, you take profits on those shorts. You say, you know what? The world changed a little bit overnight. What if what if in New Zealand they decide that they're going to start to get back to a little bit easier policy and they're, yada, yada, yada. I mean, it sends some ripple effects. So I think the Kiwi has created a bit of an exhaustion low. I don't know if it'll bounce a lot in the immediate term. It might go sideways more than bounce, but I just don't want to keep shorting it down here. Pound, we kind of talked about how it's having a nice recovery, but you can just see that kind of extreme. I mean, talk about an exclamation point. Look at that exclamation point, just that plunging price action there for 2 days. What else we got? Euro. Okay, Euro to me is kind of a little bit boring, maybe not quite as decisive and such, but if you were saying what's something that's maybe been a little more surprisingly strong of late, you could put the euro in that category. Look, that it's been trending higher versus most currencies. 20s crossed above the 50. You just held at the 50 period moving average. These are all good bullish factors. So I would still tend to lean that the euro is going to work its way higher. I'm not sure about that because you're still in a bear market, big picture, but it's looking better. I don't know. It's not been all that exciting. Now, Swiss franc has been stronger, but I think that the US dollar and the Swiss franc, they're not historically always together. They're both defensive. They do have some similar characteristics. Right now, I'm going to say that they're somewhat tethered to each other in that if I think the US dollar is putting in a bit of an exhaustion high, I probably also think that that's a little bit of an exhaustion high for the Swiss franc, that that's a little bit of an exhaustion low in risk assets, that the market's going to bounce back in the short term, that these are going to come off in the short term. And that's what the charts are kind of suggesting as well. High wave candles there. I think it's more of kind of a risk on, risk off type of move. And in this case, risk off, has been working. I think risk on will have a little bit of a bounce back for a couple of weeks. Japanese yen, hard to know. We did have, it's probably off this chart, but we did have a big exhaustion somewhere back here in the past. Started to consolidate and then kind of plunged again, and now we're back up above that range. You could, again, I'm going to put Japanese yen kind of with the euro. We're back in the choppy range, and it has been looking better than most in the short term. And over the short run, it's doing a little bit better. But this is where you could even consider, I mean, this is a hard chart to buy, right? This looks like death, but it does have those classic signs of exhaustion. Now, if you ever buy something that has been in a downtrend, buy something that has a lot of overhead supply and is trying to work its way higher, I'd much rather buy the dip than buy the rip. I'd much rather, turn to a shorter term time frame and look for a pullback that I can buy into versus trusting breakouts. Breakouts are less trustworthy because you got all this overhead supply. I make no, I'm not making excuses for Kiwi. It's ugly. It's got a lot of overhead supply. So if you're trading it, you're trading it strategically, and I think you're just trying to take a little trade here and a little trade there of buy the dip mode. So Kiwi is reversed. What might work? Well, you can see how it failed against the 50, failed, failure, 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 over and over again. Now it has succeeded above it. Watch for a little pullback to it and play that for the bounce. That would be my first thought as, a potential way if you want to play the Kiwi for this little reversal. If you look at the Aussie, which was very similar, okay, it's going to have a similar aspect to it. It's been downward trending, downward, downward, downward. Now we've kind of cleared up above. For the first time in a while, you're starting to see these, reversals starting to happen. See the 20 curling. I wouldn't just buy the breakouts. Those are a little less trustworthy. Try to buy the dip. Maybe you come back, bounce on top of that 50 period moving average and use that as the bounce area. Something along those lines would be how I would be thinking about and looking to trade that area. Good question. If you look at Bitcoin, it's the obvious one in terms of crypto land, right? So if you look at the daily chart, I mean, that's just a mess. I don't know what else you can kind of say about it. There's not a whole lot of, let me draw that line a little bit better, not a whole lot of positives that we can say about it. But here is the exhaustion low. See the plunge, see the exclamation point that we're kind of talking about in other assets. Well, crypto had its wild volatility move in June. It was just absolute collapse, and chaos. If you were talking about crypto, you were talking about these companies going bankrupt and, the blow-ups of some of these tethers and things, and some of the other crypto companies coming in and trying to buy out the other companies for pennies on the dollar. It was just an absolute mess. What we've really done is, yeah, we've bounced and such, but we've kind of come back to retest it and see that kind of inverse cup and handle type of dynamic might really be what's more in play. I have a hard time thinking that crypto gets out of this without another plunge, another, kind of test. And maybe that'll bottom out. Maybe the next one is kind of, the final bottom. But usually this isn't necessarily the bottom. It's kind of like what I'm saying in the S&P and the US dollar and so on. We're talking about a tradable opportunity for a couple of weeks, but not suggesting that this is the end all be all. In fact, I would fully expect that after the market rallies for a couple of weeks, kind of up towards that 38.50 level, etc., that we talked about early on, it's probably going to fail. It's probably going to get worse before it gets better. Crypto would certainly be in that camp of looks like it's going to get worse before it gets better overall. So Let's see what else we have on tap for this week. On the schedule, we have day trading versus swing trading, some pros and cons, and then we've got the currency recap on Thursday. And then, as always, of course, we'll have the weekend trading room that we will send out either Friday afternoon or Saturday morning. We'll send that out this weekend. Thanks, everyone, for joining us. Have a great rest of your day, and we'll see you next time. Goodbye, everyone.